Something happened today that wasn't supposed to happen. Not now, not ever. And definitely not in a world built on the illusion of financial certainty. A mechanism designed to protect the banking elite from chaos suddenly malfunctioned right in the middle of a silent global tremor. A system they built to preserve their power slipped out of their hands without warning. And for the first time in years, the people, ordinary people, were not the ones caught off guard. The bankers were. But this story didn't begin today. It began years ago when powerful institutions created a digital safety net that was never meant to fail. A hidden circuit buried deep inside the financial machine. A circuit known only by insiders as the emergency kill switch. A control device meant to freeze markets, halt withdrawals, silence panicked runs, and protect the balance sheets of the few at the cost of the many. A button so powerful that pressing it could disrupt trillions in seconds. A button so dangerous that only a handful of individuals in the world even knew how to activate it. But today, the unthinkable happened. They pressed it, and nothing happened. The override failed. And the mystery is not just why it failed, but what happens when the most powerful control mechanism in the financial world suddenly stops working. Because if the kill switch can fail, then everything else built on top of it can fail too. And that possibility is far more terrifying than the failure itself. The question now is not how this happened. The question is how long they have known this would happen. Section 2. What was this switch, and why did it exist? To understand today's failure, we must go back to a time when trust in the global banking system nearly disappeared overnight. Back to the moment when the world realized that modern finance was held together by nothing more than fragile promises and fast algorithms. The year was 2008. Governments were panicking. Banks were collapsing. Investors were fleeing. People were lining up outside institutions that swore they were safe just days earlier. And behind closed doors, a question echoed through emergency meetings. How do we make sure this never happens again? Publicly, they promised reforms. Privately, they built something entirely different. A mechanism that allowed them to shut down the system without ever calling it a shutdown. A mechanism that could freeze liquidity. A mechanism that could slow transactions. A mechanism that could block mass withdrawals. A mechanism that could stabilize markets without public approval. They called it the market contingency override, but internally, the name was simpler. They called it the kill switch. Its purpose was not to protect people. Its purpose was to protect control, to ensure that no matter what happened in the markets, the bankers would remain in charge. And for more than a decade, it worked flawlessly. Every flash crash that miraculously corrected. Every liquidity freeze that mysteriously resolved. Every sudden halt that was explained away as a safeguard. These were not glitches. These were activations. But there was a flaw. A flaw built into the very foundation of modern finance. A flaw no one wanted to talk about. A flaw that became impossible to ignore today. Section 3. The origins. How the kill switch was born from panic. The kill switch came from fear, not innovation. Fear that markets were too fast for humans to control. Fear that algorithms could trigger cascading collapses in milliseconds. Fear that the public would lose trust again and cause a liquidity drain that no bank could survive. Central banks were the first to demand a solution. Regulators followed. Private institutions quietly built the architecture. And by 2012, the kill switch existed in nearly every major financial hub. Wall Street had one, London had one, Frankfurt had one, Hong Kong had one. Each version was connected to a global web of real-time surveillance systems monitoring trillions in daily flows. If volatility crossed a certain threshold, if withdrawals spiked, if trading volume became abnormal, the switch could trigger automatically or manually. And behind all this were a group of unnamed technocrats and financial engineers whose influence never appeared in the news but shaped the entire system. But there was a problem they did not anticipate. The system they built eventually became more complex than the people running it. Dependencies piled on dependencies, patches layered on patches. And year by year, the kill switch became both more powerful and more fragile. A paradox they ignored. Until today. Section 4. The rise. Why the kill switch worked until it didn't. The switch saved the system several times. It stopped a flash crash in 2015. It slowed withdrawals during a European banking scare in 2016. It protected several crypto-linked banks during 2022's digital liquidity shock. It contained algorithmic trading spirals in 2023. For years, it appeared invincible. But each successful activation hit a growing issue. The system required increasing amounts of data to function. It depended on latency-sensitive information streams. It relied on cross-border regulatory cooperation. And it assumed that the world's financial networks would continue operating in perfect harmony. But harmony is not a feature of global finance. It is an illusion. Beneath the surface were fractures, competing interests, a growing dependency on AI-driven trading engines, and a rise in decentralized digital assets that ignored traditional choke points. The kill switch was designed for a world that no longer exists. And today, the system it depended on finally broke. Section 5. The breaking point. The exact moment the switch failed. The failure began with a liquidity surge. One market moved out of sync, then another, then a third. Within minutes, automated risk models flagged the anomaly. Protocols kicked in, signals went out, and the kill switch was activated. But instead of freezing the flows, the system overloaded. Instead of controlling volatility, volatility multiplied. Instead of halting trading, the networks glitched. The circuit that always worked simply didn't. And the reason was terrifying. Latency, cross-network delays, fragmented liquidity pathways, and outdated infrastructure. The kill switch relied on a centralized command path. But the modern market is decentralized in behavior, even if not in structure. And when the command went out, the system didn't recognize it. It didn't know how to process a unified halt across fragmented digital rails. It didn't know how to freeze algorithms that now operate independently. It didn't know how to stop liquidity that no longer flows through traditional pipes. In simple words, the world changed faster than the bankers expected. And the tool they trusted the most failed when they needed it the most. Section 6. The fallout. What happens when control disappears? When the kill switch failed, the first reaction inside the banking world was disbelief. Because this wasn't just a technical fault. It was a collapse of the one safeguard they trusted above everything else. The first panic signals came from liquidity desks that suddenly couldn't freeze positions. Then risk departments reported that their emergency protocols weren't triggering. Then central banks discovered that cross-market synchronization was breaking down. This wasn't a localized failure, it was a global malfunction, a systemic crack that exposed how interconnected the world has become. And the fallout was immediate. For the first time in over a decade, the global financial system experienced a moment without its artificial stabilizer, a moment of raw vulnerability, a moment where natural market forces operated without a suppressor. This was not chaos yet, but it was unfiltered reality, and the institutions that had been shielding themselves from reality were not ready for it. Several markets saw sudden liquidity gaps. Bond spreads widened faster than expected. Derivatives desks struggled to calculate exposures in real time. And banks discovered that their internal firewalls were unprepared for simultaneous stress. The fallout wasn't catastrophic, but it was revealing. It showed the world that the system is far more fragile than anyone admits. And fragility is dangerous because it invites pressure. Once the financial world senses weakness, it tests it, and once the public discovers weakness, it reacts to it. Today proved that the people running the system don't fully control the system, and that is the beginning of a new era, one built on uncertainty rather than authority. Section 7. The failed fixes. Why their solutions didn't work. The moment the kill switch failed, emergency teams attempted secondary overrides. These overrides were built as backups, but they were never tested under real-world stress. They relied on outdated assumptions. They assumed a hierarchy of command that no longer exists. They assumed that markets still passively respond to centralized inputs. But modern markets are algorithmic. They are autonomous. They are fragmented. And they are faster than any human oversight. The first fix attempted to reroute the command through regional hubs. The hubs timed out. The second fix attempted to slow network throughput to stabilize flows. The system rejected the slowdown. The third fix attempted to isolate high volatility nodes. The nodes were already out of sync. Then came the fourth fix, manual intervention. Teams attempted to halt specific markets individually, one by one. But by the time they reached the third market, conditions had already changed. The system was not built for manual control anymore. It was built for automated dominance. And when automation fails, the humans behind the curtain are powerless. The failure of these fixes proves a deeper truth. The financial world has reached a point where complexity has surpassed control. The system cannot be easily paused. It cannot be easily overridden. And it cannot be easily stabilized when multiple digital rails are in motion. This wasn't just a technical failure. This was a philosophical failure. A failure of the belief that humans can fully command a hyper-connected algorithmic financial universe. They can't. Not anymore. Section 8. Modern parallels. We have seen this pattern before. Today's failure feels new, but its pattern is not new. This is the same pattern we've seen across history when centralized systems reach their limits. We saw it in the 1970s when the gold standard broke because it could no longer contain global expansion. We saw it in 1998 when long-term capital management collapsed because its models couldn't handle real-world volatility. We saw it in 2008 when mortgage derivatives shattered because their assumptions were disconnected from human behavior. We saw it again in 2020 when supply chains froze because they were optimized for efficiency, not resilience. And now we are seeing it in finance's most sacred control mechanism. Every complex system eventually reaches a point where its creators lose the ability to stabilize it manually. Patterns repeat. Warning signs repeat. And failure always comes from the same root cause, overconfidence in an imperfect architecture. Today's failure is simply the digital version of a historic pattern, a system too optimized to adapt, too dependent on speed, too fragile under stress, too centralized in theory, but too decentralized in practice, and too arrogant to acknowledge its own limitations. But the most shocking modern parallel is this. For the first time in history, people have alternatives: cryptocurrencies, digital assets, peer-to-peer transfers, non-bank liquidity networks. These didn't exist the last time the system broke, and now they are growing while trust in traditional banking is shrinking. This parallel changes everything. Section 9. Shocking data. The numbers tell a terrifying story. When the kill switch failed, analysts began collecting rapid metrics. The numbers reveal how close the system came to a deeper crisis. In the first hour, volatility rose by an abnormal 18% across major indexes. Liquidity in specific bond markets dropped by 27%. High-frequency trading algorithms executed 42% more defensive orders than normal. Interbank lending spreads expanded by 14 basis points, an unusually sharp move. Cross-currency swaps experienced mismatch spikes of 11%. Retail withdrawal requests increased by 22% in under 3 hours. And this was during a contained event, a failure they were trying to hide in real time. Now imagine what would happen if the system faced a larger shock. Imagine if a crisis hit while the kill switch was offline. Imagine if people lost trust simultaneously. The data suggests the system cannot handle that level of stress, not anymore. The most alarming number is this. Today, 68% of global financial transactions rely on digital rails built more than 15 years ago. These rails were not designed for algorithmic markets. They were not designed for high-frequency liquidity. They were not designed for decentralized assets. They were not designed for trillions moving at millisecond speed. And yet, the entire world depends on them. This mismatch is a ticking time bomb. The failure today was not the explosion. It was the spark. Section 10, repeating patterns. Every collapse starts with a small failure. Before every major financial meltdown in history, there is always a small event that insiders ignore. A minor anomaly, a miscalculation, a tiny system fault. But these faults are never isolated. They are signals. Signals that the underlying structure is cracking. The collapse of the gold standard started with small imbalances in foreign reserves. The dot-com bubble started with a few unrealistic valuations. The 2008 crisis started with a small rise in mortgage defaults. And now we have a small technological failure in the world's most important control mechanism. Every collapse has the same signature: a warning, a denial, a delay, then the inevitable. Today's failure is a warning. If ignored, the next phase will not be as gentle as this one. Section 11, the bigger picture. Why the bankers really lost control. The true loss of control wasn't the malfunction of a device. It was the exposure of a truth they hoped the public would never notice. The truth that modern finance is too complex to be ruled by a small group of institutions. The truth that no single entity can stabilize a world running on independent algorithms. The truth that centralized power is weaker than decentralized behavior. The truth that human oversight cannot command machine-driven networks. The truth that trust is fading faster than control can be restored. The truth that the system is entering a self-reinforcing loop of fragility. They didn't lose control today because something broke. They lost control because the world evolved past their tools, past their assumptions, past their safeguards, past their illusions of authority. And the most terrifying truth for them is this: once people realize the system is vulnerable, the system becomes vulnerable. Perception drives behavior. Behavior drives liquidity. And liquidity is the bloodstream of modern finance. When liquidity weakens, everything weakens. And today was the first moment in years when that weakness became visible. Section 12. The twist. What if this wasn't an accident? There is another possibility, a darker possibility, one that insiders quietly whisper about but never publicly acknowledge. What if the kill switch didn't fail because of a glitch? What if it failed because someone bypassed it? What if parts of the system have become independent enough to reject centralized commands? What if rival institutions modified their rails to insulate themselves? What if regulatory fragmentation created incompatible responses? What if the architecture has splintered into factions? The financial world is no longer unified. It is competitive. And competition breeds incompatibility. This twist changes the narrative completely. Because a malfunction can be fixed, a fragmentation cannot. A glitch can be patched. A structural shift cannot be undone. If today's failure was caused by fragmentation, then the kill switch may never fully work again. And that means the era of centralized command is ending. But the era replacing it is unpredictable. Section 13, the real-world impact, how this affects everyone watching. Most people don't think about financial infrastructure. They think about their savings, their transactions, their day-to-day security. But when the system behind those basic functions becomes unstable, everything people rely on becomes uncertain. If a kill switch can fail, then transaction networks can fail. If transaction networks can fail, then withdrawals can fail. If withdrawals can fail, then liquidity can freeze. And when liquidity freezes, society freezes. This is not about fear. This is about awareness. The people who understand the system prepare. The people who don't panic. Knowledge reduces panic. Today's failure is a message that the safety net is weaker than advertised. And that means individuals must think ahead rather than trust blindly. Section 14, 3 clear takeaways. Takeaway 1, centralized control is no longer guaranteed. The system has outgrown the tools designed to manage it. This is a structural weakness, not a temporary one. Takeaway 2, digital fragility is rising faster than stability. Measures, infrastructure built for an older world cannot support the speed and complexity of the new one. Takeaway 3, the next failure will be bigger and will arrive faster. Not because the system is doomed, but because the safeguards are outdated. Every new stress test will push it closer to another breaking point. Section 15, final warning. The window is closing. This event may fade from the news, but inside the institutions that understand what happened, the alarm is still ringing. They know the system is showing early signs of a larger breakdown. They know the kill switch, the ultimate safeguard, is unreliable. They know control is slipping. And they know the next crisis will expose even deeper vulnerabilities. The window to prepare is open, but it won't stay open forever. Section 16, natural call to action. If you want to understand where finance is really heading, if you want to stay ahead of the shifting landscape, and if you want to know the truth behind the systems that shape your future, then follow the journey. Because this story is not finished. This failure was only the beginning. And the next chapter will decide who adapts and who gets left behind. Stay informed, stay prepared, and stay ahead of the system while you still can.